go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
In terms of the handover or the opening that's coming in for the Asian market is a positive opening so far. Whether you look at the Nikkei, whether you look at the ASX 200, Hang Seng, Shanghai, all of them are managing to hold on to gains.
The S&P was flat, the Nasdaq was up about 0.25% or so, nothing very much at all.
Street expectations are extremely aggressive on this year's dividend. So the estimate that's doing the rounds is anywhere from 2.5 lakh crore to 3.5 lakh crores.
So 24,600 on the Nifty, 24,630 on the Nifty. It's about 0.1% higher. The Nifty Bank is up about 0.9. Nothing. It's basically just about holding on.
Finally, I think there is no really run on the deposits. I mean, that's another important thing, which needs to be looked at.
Mid-caps in the green, but trailing the frontliners. Mid-cap index of a gain of about 0.5%. The advanced decline ratio, though, is positive.
Not giving any specific guidance on margins. However, it's important to note that our key core drivers like global specialty business, India, emerging markets, and other business are well positioned to grow.
I think all of the issues will be resolved. I think that much I can say.
The index is up almost 1% and so is the sensex.
Well, that is the day so far, and it is actually turning out to be a fantastic session. The early week blues are all but gone, and we are back at about 24,800, 24,900 kind of level. So, the expiry is done. The pre-expiry week is almost done, 1 hour to go, and will we get a bit of a clean slate over the next few sessions? That's the question. We are coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surbi and Rima here with me in the studios, and Nigel is joining in from the newsroom floor. Guys, good afternoon.
Hi, afternoon. Doing really well and actually doing better than some of the other global markets as well. So it's been a week of consolidation. Up until yesterday, the indices were down between 1.5% to 1%. But I think today is changing a lot of that, guys.
And considering the last week, we added about, 4.5% on the Nifty and the Sensex, 6-7% on the mid and the small cap. We haven't given up too much. So week to date, the Nifty is just down close to about 0.5%. So we've retreated, but hardly in context to the kind of up move that we had in the prior week. All in all, seems like a good close to the week, Nigel.
Well, that's right. It's good close to the week, it seems. But I think we're still in that band. However, I think Monday's trading session will be crucial because the US markets will be shut. So we'll be purely on our terms. So let's see whether or not the domestic money can come in and, in fact, get us past the 25,125, which has been a bit of a resistance zone. So no worries going into the weekend. Let's see whether or not we can build on to Monday. Hopefully, the next 60 minutes don't have any kind of negative surprises. But I think we have Ashish Kayal who joins us on the show for some closing strategies. Hi, Ashish. Good afternoon. Good to see you in. Ashish, what's your take on today's trading action and how would you trade the Nifty?
Hi, Nigel. Afternoon to you and all the viewers as well. If you look at Nifty, interestingly, over the past few days, we have seen 5 days of correction. And that 5 days of correction is ideally not even retraced one candle, which was formed on 15th of May. So 15th of May, Nifty rallied from around 24,500 towards that 25,000 mark, and it has taken 5 days to retrace that. That clearly indicates that the overall undertone is bullish. Price found the support near the 20 DMA. And sharply bounced back today. It's managing to close above the prior day high as well. So it's turning the trend on the upside. I'm optimistic that we will see 25,100 followed by 25,300 levels on Nifty on the upside. On the downside, the support for the index is going to be near today's low, which is 24,630. So positionally, it's a buy. Any dip should be used as a buying opportunity, aiming for 25,300 levels on the upside.
Ashish, hi, afternoon. What about stocks? What's on the table today?
From the stock-specific perspective, the first pick is going to be ICICI Prudential Life Insurance. We can see a very strong breakout on the upside in the stock after some time. The volumes have picked up pretty well. The stock managed to bounce back from its 20 and 10-day average, aiming for the target of 672. And on the downside, the stop loss can be 487 levels. And the next stock on the buy side is going to be NMDC. We can clearly see that NMDC has been consolidating for quite some time. It has been an underperformer, but showing a strong breakout. It formed an double bottom pattern, breaking out that neckline. So NMDC can be a good bet now, aiming for the target of around 77 on the upside. And on the downside, support for the stock is around 70.50.
Okay, all right. Thanks a lot for that, Ashish. Well, let's focus on a couple of sectors then. In insurance stocks, they're in focus. We have a positive note coming in from UBS. Nimish joins us early on the show today to run us through what is their rationale. Nimish?
Well, Nigel, all the stocks are buzzing in trade, and there is an interesting report from UBS today. They've done actually constructive on the sector, and some interesting observations that they've made in that report. The first one is they believe that the insurance sector had gone through multiple rounds of regulatory overhang. That seems to be changing now at the margin, and all the industry players have actually turned out to be more, constructive or more stronger post the changes in the product mix as well as in terms of structure. So that's one big positive that UBS is watching out for. Second big important thing is UBS believes like what we've seen in other financial subsidiaries like RBI and SEBI, they expect similar softer stance from the regulator IRDA going forward. So that any benign outlook from the regulator would be a huge positive for the sector. That's the strong belief of UBS, and that's the reason why they've turned a bit constructive as well. Also, from here on, they expect the earnings to improve on the back of change in the product mix. Also, there's going to be a change, potential trigger in terms of they could benefit from the interest cuts as well. So again, that's something which UBS believes could be a re-rating trigger for a lot of the insurance sector stocks. In terms of preferences, they prefer Max Financial and SBI Life as their top bets. In fact, they've raised a target price in both Max Life and SBI Life. On Max Life, the new target price is 1665, and on SBI Life, they've raised the target price to 2100. They are neutral on other two names, HDFC Life purely on valuations, and on ICICI Pru Life, they're neutral largely on back of weak internal. So the preference clearly seems to be with SBI Life and Max Life.
Well, that's right, and they expect better profitability as the ULIP as a percentage of their total mix goes down as well. So interesting times. Prakash Diwan joins us on the show. Hi Prakash, good afternoon, good to see you in. What's the view on insurance companies?
Sorry, quite positive, Nigel. There is absolutely no indication that there's any kind of a slowdown. Each of them is getting their mojo in terms of what's the right product mix, what's the right channel to sell their products through. But if you look at some of the moves that we've seen in insurance, they usually come in when a company's strategy gets full blown. I mean, it's full blown in terms of implementation, and it starts kind of accruing some sort of results. So from that perspective, HDFC Life probably seems to be better placed because they've had a head start as compared to some of the other names. But best is to take a basket approach. Don't worry about which one should do well and actually beat others to the races, but take a basket approach, buy all four of them, and you'll be probably sorted with that. So that's the approach that I've always recommended, and it has worked given how each of them kind of reconfigure themselves. But HDFC Life does have some salience at this point in time.
Prakash, Honasa, 18% up now on Honasa. It went through a period of derating. Stock crashed to levels of 200. If you remember, in the September quarter, they had reported a loss. Their core Mama Earth brand business had started slowing down. Investors were concerned. It's rebounded, but it's still about 40% away from its recent highs. Is it a buy? Has it turned the corner?
I don't think so, Rima. It's turned the corner for sure in terms of some of the metrics. Things have started looking up. The repair is kind of taking shape. But whether you want to bet on a business which is still beleaguered in terms of a lot of the inventory losses and all that have been part of the journey till now, the answer is you have far more proven this thing. See, this result season has very clearly thrown up surprises on the favorable side, where a lot of companies which were not anticipated to reflect revenue growth and margin growth have actually done so. So, if you see the smattering of choice that you have, it's fairly large. In fact, companies like Honasa will have to continue doing like this for maybe another 2 quarters to really start validating it, the valuation that it deserves. But I would wait for it. I would be patient, give them time for the turnaround to be much more cemented than what it is. So 1 quarter shouldn't kind of change things so dramatically.
One is, of course, product acceptability and things like that. If you remember, there was one issue, which is, and these were purely allegations, that they'd push a lot of stock to distributors. And then they
And then they revamped the entire distribution.
Yeah, and they were not able to clear that. This was, I think, the quarter after, the first quarter, the second quarter after listing. At that point, there was a lot of hue and cry around it. And they clarified that, they've revamped and it's going to look a lot different. So let's bring in Mangalam now, who's joining us with exactly that question. Of course, there is the quarterly numbers, but more importantly, Mangalam, if you managed to speak with analysts, etc., on this one, what's the overall sense on Honasa from here?
Well, so everyone believes that maybe the tide is turning, but you have to look at the numbers over the next few quarters to know whether this is sustainable or not. But from what you see so far, it seems like they've pushed through growth via giving a lot of sales promotions, and a lot of the distribution stuff is getting sorted as well. Why do I say that? Because a 13.3% revenue growth is underscored by a 21% volume growth. Typically, a 21% volume growth with 13% growth tells you that there has been a realization drop of almost 10 to 11 percentage points, that maybe them taking their products out of the shelves as well, which is why it's not reflecting in the margins. The 13% revenue growth, the margins have come off from 7% to 5.1%. They've actually had to spend more on advertising. So as a percentage of sales, advertising is 34.4%. The street, typically what happens is, if your revenue is growing a lot faster in teens, etc., then you see, the percentage of advertising spends come down, and that's how leverage plays out. Other expenses obviously have increased because of their distribution reset project that they've gone down for. But the important part is there are a couple of highlights that suggest that maybe the tide is turning. One, 70% of Mamaearth's business, which is their core business, is actually growing in double digits, and it's growing in important channels. They're adding presence in physical channels as well. And at the same time, a large part of their revenue jump has happened on account of their own sales force. And also, we're seeing diversification away from Mamaearth. So Dermaco, for instance, has hit that 100 crore mark when it comes to offline retail sales. We've also seen all the other brands, which include the likes of Dr. Sheth's, Aqualogica, as well as B Blunt. They've all increased, sales by about 30%. So the wheels are set. Let's see whether they pick up pace or not. But just a cursory glance at their presentation, and that tells you, how fast the night changes. Because about a year and a half or 2 years ago, everyone was talking about the naturals wave, which is what benefited Mamaearth the most, because their products were all, the positioning was all nature-based. But now, as the beauty trends move to ingredient-based beauty, they've also evolved their portfolio. Look at their presentation, and you'll see things like, peptide, you'll see hyaluronic acid, you'll see salicylic acid, you'll see keratin, you'll see, microneedle serums, etc., which sounds like they're out of a chemistry lab, but that's the nature of beauty, and that's how they've tried to evolve. Let's see whether customers accept the new Honasa with that positioning.
Absolutely spot on, Mangalam. I think we've all found ourselves caught in searching what are these new assays and what this peptide means and what this particular, serum, alpha hydroxy, etc., does to you. So, yeah, I think
I have tried a lot of them, and I will take that for the team.
They work? In that case. No, jokes aside. But yeah, that's become the new wave of beauty from Besan, Haldi and Chandan. Now we've moved to full-blown chemistry. Got that point. Thanks very much for that, Mangalam. Okay, Honasa, definitely a winner of the day, and what a winner, 18%, big move coming in. By the way, the other side of the market that's really, pulsating and throbbing and rising higher is once again the capital market space. I was looking at BSE, but then BSE is not alone. BSE, you can argue, there's a lot of back and forth about what happens if this weekly expiry is shifted, and there are some notes that are saying that BSE stands to lose about 15% market share in the options premium segment. That's one. But look at Angel now. Look at a couple of other names as well, which have also started rising. So in general, it seems DAM Capital, I saw DAM Capital is up in double digits as well. So once again, this capital market space is alive and kicking. Prakash, good afternoon and happy Friday to you. Market goes up, the stocks come back in favor. But what's your sense? What to play here and what to avoid?
I think good afternoon, Samita. I don't think there's any reason to avoid this space. The brokerage names have a strong direct correlation to volumes and, how the market behaves. In fact, they are probably the only names which lose out on some ground of sorts when markets come down or cool off, because the activity levels come down. But technically, buying or selling both will continue irrespective of where the market's headed. It's just that the participation levels aren't at the peak that we saw earlier. But as we draw closer to higher highs on the indices, there is a lot of activity. And remember, there's this big change that's happened over the last 10 days, and that is a lot of IPO activity has come back to the market. We didn't see any IPOs in the Feb to April kind of a phase, but certainly you have a lot of them lined up. Some of them are already kind of making waves in terms of anticipated listing gains and all of that. So my sense is this is an all-weather kind of a portfolio. Now depends on what side of this thing you want to choose, value chain. But as I keep saying, the fintech, the KFINs and the CAMs of the world, the CDSLs of the world will definitely be always in great shape. So it's better to bet on those because they're more secular in terms of the growth trends and the kind of margin profile they sit on. So I really won't worry about dips out there. In fact, it's a good time to buy when there's some sort of a softness. Not maybe a day like this because there's too much of exuberance. And there's a very clear sector rotation that's happening. You have defense, then you have FMCG, then you have capital markets, someday you'll have capital goods, railways. So the market's waiting to latch on to newer themes every day, every week. So don't buy things when that's the day where that particular theme is actually in the limelight.
Okay, all right. By the way, just pull up the intraday chart of AIA Engineering. I think that just came out with the set of numbers. And it seems the street actually liked the set because the stock as we speak is spiking up. It was in the red. Now it's seen a bit of an uptick. Let's pull up the intraday chart out there. I think that will tell you a better picture. Prakash, I wanted to ask you about Cosmo Films. There was a fire at the Jindal Poly unit. And I don't know how much of the capacity goes out of the way. But it appears, going by the move that we're seeing on Cosmo first, the street believes that they could be potential beneficiaries. Have you done any math? You should track the space, so I ask you.
Right. So, but the unfortunate part is that Cosmo First is gone beyond films in a lot of other areas, which means that, they might not be a very first order impact. There could be some benefits, of course, coming to them in terms of market share. But that also will be short-lived because these capacities kind of, tend to get worked upon by a lot of other players. So you have so many of them who are always capable of doing that, maybe with a lag, but Cosmo has underutilized capacity, and that's where the street probably feels that they will be, direct beneficiaries. But you will have to evaluate the business from an SOTP basis, and from that perspective, there's still some way to go before it starts kind of getting traction. The earnings growth that you would expect a business like that to have. Good business, very strong pedigree, good history, everything's fine, but it's just that the business has to start showing some sort of traction before you put your money behind that.
Prakash, the other two names, I don't know if you have any thoughts on what's going on. Lots of talk, though, around these. R Power, 15%, and Reliance Infra, 7%. They're, amongst the top 5 volume-led moves today. Huge volumes. Any thoughts?
The only thought that I have is when these names start making waves, you know what is happening in terms of market interest. So there's slightly more broadening of interest. These you can add Suzlon to that list as well. So a lot of money, is again coming back. FOMO will always drive people to buy into things which are more newsy, but the much more stronger, boring names will probably get sidelined. So that's what typically happens. So, and I'm sure there's some news flow around it, but whether the news flow is commensurate with the kind of 14-15% move that our power is showing, that I really don't know, because the math is fairly complex here. There's so many moving parts. So I have never been able to get that right, to be honest. So that's why I don't track much of that. But generally, symptomatically, I've seen that this is what happens when there is strong FOMO and you want to buy into something which is erstwhile penny stocks, which seem rewarding at this point in time.
FOMO there is no doubt about it, and I think that's absolutely the case. Prakash, thank you very much for joining us. It's always a pleasure. Have a good weekend. We'll talk to you again soon. Now, the RBI has board meet to review their FY25 balance sheet and decide on the dividend payout of the government. It's just concluded. Last week, the board had reviewed economic capital framework ahead of the dividend payout. Now, the big debate in money markets is what is that check size going to be? The CNBC-TV18 polled the dividend at 3 trillion rupees. So as we slip into a break, just a quick primer on the significance of what the RBI transfers as dividend to the government of India. Lata is here with that explainer.
Markets, especially bond markets, are keenly awaiting the Reserve Bank's dividend. As per the budget estimates, it should be around 2.5 trillion rupees. In fact, a little less, versus 2.1 trillion that the RBI declared last year. However, there is a widespread feeling in the market it will be more than 2.5 trillion. So we did a poll, and a poll of economists, which indicated that the dividend may be 3 trillion rupees. Here's why the market is expecting a bigger dividend. The Reserve Bank of India data shows that RBI has sold a whopping $415 billion in FY25, that is from April 2024 to March 2025. This compares with sales of only $153 billion in FY24. Now, every time the Reserve Bank sells a dollar, it will be at the current price, at right now 84 or 85 rupees, but its purchase price is calculated as the average of all the reserves that it has accumulated. Right now it works to around 78 rupees, according to experts. So the Reserve Bank had made about 6.5 rupees profit every time it sold dollars in FY25. That means the Reserve Bank made 6.5 rupees multiplied by 415 billion, that is 2.7 trillion rupees. In FY24, if you saw the math, the Reserve Bank sold only $153 billion and therefore it made only 1.2 trillion rupees. So only on this count, on dollar sales, the surplus of the Reserve Bank in FY25 would have been 1.5 trillion rupees more than in FY24. Last year's dividend was 2.1 trillion, so this year's can be 3.6 trillion rupees, according to this math. However, there are two other important components of the RBI's income, and they are interest income on foreign securities that they hold and Government of India bonds that they hold. Now, RBI's foreign securities holding as of March 31 was a whopping 48.6 trillion, but that's only marginally higher than what it was last year as of March 31, 24. It was about 48 trillion. While Reserve Bank of India's India securities, Government of India securities, was 15.6 trillion in FY25 end, slightly higher than 13.6 trillion last year, that is FY24. But because of rate cuts in the year gone by, total interest income from Government of India bonds this in FY25 would have been slightly lower than last year's. In short, RBI's income is expected to be 1.5 trillion more than last year, largely because of profit on dollar sales. Now let's come to expenditure. As for RBI's expenditure, the big change, a changing element, if you can call it, is how much Reserve Bank transfers to the contingency reserve fund. Salary and all that remain the same. Now, the Jalan panel requires that RBI has to keep 5.5 to 6.5% of its balance sheet as reserves. In FY25, an RBI panel reviewed the rule. But we don't know if they changed this 5.5 to 6.5 requirement. As of March 2024, Reserve Bank's reserves were at 6.5% of the balance sheet. Now, RBI may exercise its option and bring down the reserves to 5.5%. That is still within Jalan Committee rules, given that there are higher defense expenses for the government this year. Also, there is no fear that higher money printing will increase inflation because this year, CPI inflation is expected to remain below 4% for the entire year. Hence, the expectation that the Reserve Bank may declare a 3.5 trillion rupee dividend this year.
Okay, welcome back. Ronak Konkar is now with us, co-fund manager of equity and head of research at PPFAS Mutual Fund. Ronak, great to have you with us here on the program. Thank you, as always, for being with us. So let's just start with the two capital market names in your flexi-cap fund that are very visible. One is, of course, Motilal Oswal. The other is MCX. And I ask you this in the context of this entire NSE, BSE debate. It was our story yesterday, which we said that both exchanges want Tuesday as the expiry day, and then of course we'll see what happens. Just your, BSE is the only listed stock exchange. You own MCX. Is it just about sort of owning the dominant kind of player in the space? What are your thoughts? I mean, why not have BSE in your portfolio as well? Not now, it's already done phenomenally well, but just trying to understand the thought process.
Prashant, thank you for inviting me. Good to see you. It's a nice question. So the whole idea is, if you look at any of these capital market intermediaries, they are essentially network effect plays. So you need more buyers, more sellers transacting on these platforms, and that generates the economic value for this business. And from the capital requirement point of view, all these companies are very capital light, except for the regulatory capital that they need to hold. And any of the new services that they sell, like data feeds or anything, are essentially incremental profits for them, because the data anyway is their own proprietary data. So because of this model becomes very attractive, and going with a dominant player usually helps, because the network effects can be quite strong and very difficult to penetrate. Although we have seen in the past that when NSE was not there, BSE was very dominant. But once NSE came, BSE's dominance a little bit waned in the core activity of stock trading. So it's not guaranteed that any platform will retain its dominance. But once you are at a critical mass, these platforms tend to be very sticky, and transactions and volumes tend to converge to the more dominant player. So that's why dominant players with higher market share are preferred.
All right, got that point. Ronak, hi, great to have you this afternoon. Before we talk more, themes and sectors and what you like and how the portfolio's moved, I have to talk to you about the cash levels. Now, between money market instruments, cash, arbitrage, you're holding 26% cash in the portfolio. I think it's the highest we've seen, across the industry in a very long time. Definitely, I think in my reporting career. And what's the sense here? And we've had a correction, but yet your cash has been high. Is valuation still a problem? And at some point, isn't that going to become a bit of an issue with investors if the market keeps rallying?
So maybe in the history of PPFS, this is not the highest cash position we have had. So we have had about close to 30% cash holding of the AUM when we were in the 2018-2017 bull market, when the same situation occurred, that wherever we wanted to look or take a position, the valuations were not too attractive. And even today, even after the Q4 results are out, many of the sectors where growth has been very, very promising and growth has been beyond expectations, the valuations of those sectors are actually significantly above the median valuations they were quoting. Now, one can assume that these valuations can continue to go up and up, but that's not how equity market or cycles work, right? So if cycle turns against these companies, then the valuations can derate very, very quickly. So it's better to be cautious when you're looking at a market which is generally a little overvalued. And in India, if you're seeing most of the sectors where the businesses are very stable and the growth rates are quite moderate and in their long-term averages, the valuations have not corrected as much. Where the valuations have corrected significantly is where the cyclical tailwinds of that particular company or a sector have disappeared for a short period of time. And that's what cyclicality does. So the valuations might look on a normalized basis very, very expensive, but on a short-term basis or a trailing 12-month basis, they might look reasonable. So we are not seeing valuations at an attractive position right now. Hence, the cash has been there. So it's a bottom-up call. It's not a call based on the market has to fall or correct and we'll deploy. And we have been deploying. So if you see the last month's fact sheet and this month's fact sheet, a lot of the existing names is where we have added our positions. And more or less the weightages across sectors also remain the same.
Ronak, hi, you've exited ITC Hotels. Is that correct? That's the recent change?
That's the only recent exit we have done. We got it in the demerger from ITC Limited. We still continue to own ITC, But ITC Hotels is something where we see the valuations and the growth rates are not very, very reasonable at the moment. So we will reevaluate. So we are tracking this sector very closely. We are aware of this business model. But at the moment, the valuations are not attractive.
Hi Ronak, good afternoon, good to see you again. Ronak, I'm looking at the same set of stocks that you have, Coal India, Power Grid, Petronet, LNG. Coal India, what's the view over there? Because, it had valuation support, but now the fear is that they could start seeing degrowth in volumes. What's your view on the stock? Valuation comfort, yes, but if they start seeing degrowth, then that's a worry, right? Captive coal mines are ramping up.
So that is again a thing we have to wait and watch, because any of the mining capacity coming up does take time, and by the sheer volume of which Coal India operates, to suddenly dislodge the supply chain is also very, very difficult. So at the moment, the ramping up of volumes itself for Coal India is happening. Production mechanization has been happening for a while. Their productivity improvement also has to be seen how it goes over a period of time. So I think over a period of time, the thermal piece of power that we use as a base field for the domestic power consumption in India, that I don't think is at a threat. In the longer term, yes, renewable sources will definitely try and edge into it. But as the power needs keep going up, as more manufacturing capacity India wants to put up, more households are also being built. At the same time, we want EV penetration. We want all the modern facilities that all developed countries also enjoy. So all of these needs power. So power demand itself is on a growth trend. So it remains to be seen where the volumes actually will grow. But short term, anything can happen. But longer term, I think it's not there yet where we can completely phase out coal power and say now we can depend fully on renewables.
No, absolutely got that. Just a quick word on your US tech exposure, Ronak. That's remained static, right?
That's remained static. We own 4 of them. So if you remember, RBI has not allowed mutual funds to invest globally after 2022. Since then, the overall allocation of the US stocks in the portfolio has also come down for us. Most of the incremental flows have been into Indian stocks only. And we have the 4 stocks. We own Microsoft, we own Alphabet, which is the parent company of Google. We own Amazon, and we own Meta, which owns Facebook, Instagram, WhatsApp. So all of these companies are on a very, very different growth trajectories of their core business as well as the cloud business and the social media and digital advertising business. These are actually long-term tailwinds, and it's actually most of the time it's surprising to see at the scale at which they operate, they continue to grow at these growth rates and with the return on capital that they generate despite spending so much money on the GPUs and computing capex.
And did did the team at PPFAS have a discussion about? I mean, the only thing you can do is reduce exposure here to these 4 names. You can't add. They went through a bit of a drawdown phase earlier this year. Was there any discussion at all to trim position before that or during that period? At all? No.
In the drawdown, it's actually better to add on to these stocks, but unfortunately, we can't add at the moment. But whenever we earn dividends from these companies, we do reinvest in them. And anyway, we are free to reshuffle this portfolio. So if we feel like selling one of them and buying something else in the international markets, we are free to do that. But at the moment, the tailwinds I spoke about, all these companies are running on, they are very, very strong for them. And the nearest competitors are not there yet in terms of scaling and also building the distribution advantage that these companies have. So it remains to be seen whether the dominance of these companies is waning. But yeah, cyclical or valuation fluctuations are fine. We can tolerate them.
This news on Google or Alphabet, which you own, that the number of searches is down for the first time, I think, in 15-20 years or something, right? That was the last data point because of things like Perplexity, things like all these large language models, etc. Does that worry you at all at the margin?
So in fact, it's a good thing and a bad thing. Bad thing because the company is reducing its search volumes. But again, it's a platform change as well, how people are consuming search as a product now. And it's actually a good thing because if you see, Google has been in the crosshairs of antitrust for a very long period of time. And because of that, if a new competitor can take some volume of search from a major player, actually a good sign that competition is still thriving. And it remains to be seen what happens to the case that they are fighting in the department with the DOJ in the US. But it's interesting to see that competition is still thriving and Google has to pull up its socks and improve its product if it wants its search results to go up.
Out of time. Ronak, thank you very much for joining in. Enjoy your weekend. So that's the word coming in from PPFAS. We will slip into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTST calls.
Welcome back. Nifty up close to around 250 points. So good going out there. Well, the couple of stocks that are doing well, Reliance Infra and Reliance Power, they are one of the top volume movers in today's trading session. So big up move is what we're seeing out there. HFCL, they reported its numbers very weak, but from the lows, that as well has moved into the green. That said, it's time for our favorite segment, D Street Chatter. Nimesh is back with us. Nimesh, what are you picking up?
Well, Nigel, it's been a kind of a day when we opened gap up and we've sustained that. But I guess today's rally is largely a short covering rally, and to some extent supported with the IT stock. So the IT index is what helping the bulls to fight today's rally. And as you rightly pointed out, HFCL, there are so many such stocks, despite weak numbers, are trading up largely on the back of short covering. And that is essentially for two reasons. First reason is the RBI dividend, right, which is going to get announced today. It could be a big number, which will surprise the street, and maybe I think market is playing for that. And the other big buzz in the market is maybe you'll hear a big rating upgrade from a large foreign agency for India. That is something which the street has been anticipating for the last couple of days. If that turns out, you'll see further rally. And maybe because of that, you're seeing a bit of short covering as well in today's market. From a flow perspective, yesterday there was a clarity of a large sell trade. Today seems to be quite mixed and quite muted as well. I guess the only space which continues to see buying interest is PSUs, and for a change today within the PSUs is the OMCs which are well bid. So again, it's kind of a sector rotation within the PSUs as well. You'll see some of the other PSUs doing good on a daily basis. Even the broader market, the index may look just 0.5% or 0.7% higher, but there are a lot of individual names which are buzzing in the broader market stocks. So the momentum is clearly there in the broader markets from a flow perspective. I guess from a Nifty and the Bank Nifty perspective, it's more of a short covering rally today.
Well, that's right. It gives you a pulse of the mood, right, Nimesh, when the broader markets do well. But what about individual stocks? What are you picking up?
Well, again, I'll start with the stock where there was a large block today. The stock is under pressure, which is Gravita. There's a large block in the morning trade. I understand the promoter entity was a seller. And within the buyers, one of the large domestic AIF was an anchor investor. So again, disclosures could be quite interesting in Gravita India. So that's the first stock. The second stock is Supreme Industries. The entire space, seems to be buzzing in trade. Supreme stands out. One, there was a clean out trade by leading FII today, so they've sold out. Some domestic mutual funds have bought, is what I understand. And in general, there is a bit of interest back in the entire space, and so is Supreme, which is the leader in that space. So that's the second stock. The third stock is HDFC Life. I spoke about the UBS note. The entire life insurance space is buzzing in trade, but HDFC Bank stands out in terms of good buying interest. And also remember, HDFC Life is now virtually at an all-time high. So there could be a big breakout as well on HDFC Life from a technical perspective. So that's the third name. And the last stock is Federal Bank. For second day running, the feedback is there is supply from larger institutions in Federal Bank. So there is the delivery is on the higher side, but that's on the sell side by larger institutions.
All right, interesting names, Nimish, with what you're picking up. So we'll keep an eye on some of this stuff. By the way, Ashok Leyland numbers are coming out, and numbers look pretty decent. Almost 39-40% growth in terms of net profit, 1,246 crores. Margins seem to be better by almost 100 basis points. Revenues are up about 6% on a year-on-year basis. More as we go along. Stocks did a bit of a spike and then it's now started to come off. Ashish Kayal is with us to run us through what to buy or sell today for a reverse trade on Monday. Ashish, good afternoon. What do you have?
Afternoon, and if you look at the overall broader market, I think it's bullish. We can clearly see the markets are buy on dips, and having said that, there is a lot of activity buzzing around. So for the BTST or for Monday, you can possibly look forward to pick up the stocks which are outperforming. Something like Hindustan Copper. For some time, it has been consolidating and underperformer, but reversing back on the upside. Formed a breakout from the inverted head and shoulder pattern. The target on the upside comes to around 270, and on the downside, one can maintain a stop loss of around 225 levels. The next stock on the buy side is going to be Tata Chemical. Again, we can see it is about to give a breakout, not yet done that, but there is possibility we can see a breakout. Volumes have picked up, so Tata Chemical can do outperformance from here on. 920 is the target. On the downside, one can maintain stop loss of 855 levels.
Okay, all right. Thanks a lot for that, Ashish. Well, let's run through a couple of numbers that we'll be getting a little post-market as JSW Steel. We're looking at the consolidated numbers. Revenues are expected to see a flattish or mildly negative number. The EBITDA number, though, will improve, which tells you that margins are likely to improve. The profit number should come in at around 1,500 crores. What are the factors at play? JSW Steel will get some kind of benefit because they are a facility at Vijayanagar. That's come on stream, so that will contribute some additional volumes. On the standalone business, volumes will improve. However, realizations on a year-on-year basis will be under pressure. But you'll be looking for a bit of an uptick on a sequential basis with regard to their realizations. The crucial number to track, as always, will be standalone EBITDA per ton. That's expected to come at around 8,800 rupees, which compares to around 7,800 rupees, both on a year-on-year as well as on a sequential basis. How does this happen? They've been working on their operating efficiencies. Input costs will come in lower. That's primarily coking coal, going by what Tata Steel as well said. And realizations, HRC prices have moved up. Remember, 75 to 80% of their mix is on HRC, so that's what will help them. On the overseas operations, they could continue to struggle. However, on a sequential basis, we should see the losses that should come down. All eyes will be on the commentary, particularly on Supreme Court's verdict with regard to liquidation of Bhushan Power and Steel. What is the clarity? Will they bid again? How are they going about things? That's going to be top of mind. I'll be speaking to the management as well. We'll get you a slice on Monday morning. But JSW Steel, top stock to track for Monday morning trade. Gurmeet Chadda is with us, managing partner and CIO at Complete Circle. Hi, Gurmeet. Good afternoon. Good to see you in. Gurmeet, I wanted to ask you, what's the view, not on JSW Steel, but what are you all doing with solar now? The time to add is over, or are you adding even now?
It's always tough, Nigel. Thank you. Good afternoon to you. When the stock goes up so much in terms of build further conviction and add. We are not adding anymore in portfolios where the stock has become more than double digit. We are trying to rebalance a little bit. But we continue to be very constructive on the defense expenditure. I think the government emergency purchase of 40,000 crores of defense products will get announced pretty soon. Also probably could be a function of the RBI dividend. Second, the global military expenditure, Nigel, last year was $2.7 trillion. And this grew 9%. from 23. This year, the growth could be 13 to 15%. Now, if you take 2 years growth of 13 to 15%, you're talking of an additional opportunity of $700-800 billion other than the spend which happens. And, so I think there's a huge opportunity for exports as well, which includes drones, includes BrahMos, includes the air surveillance and defense system, like the new one we are developing, which is Project Kusha, which has been assigned 40,000 crores. So I think the runway is big, but probably I agree with you. Maybe a lot of the good news is in the price. So you have to be selective here. And, it may see some price correction at some point of time. That might be a better opportunity to add.
Okay, that's solar industries and power stocks. Gurmeet, hi, good afternoon. Want to draw your attention to Sun Pharma and what you made of the commentary, the numbers and all of that, because it seems that the specialty business and the US business was a little below expectations in the fourth quarter. But, and then there is this constant unease. We don't know what's the policy shift in the US now on pharma imports. What's your thought on the stock?
So two things, in the near term, there will be pressure because of the tariff overhang, what Trump says, tweets the next day. So there will be pricing pressure. But, if you see the pricing pressure on generics now, it's been there for a while. And no new incremental capacity has been added because of that, which means there are very limited players now in that space who can compete at that pricing. And obviously, it will vary from therapy to therapy, in different generics from chronic to other segments. So I think one market is disappointed that, they thought that the specialty business actually will do the heavy lifting, especially in terms of margins. That did not come through. So that's the reason you can see a touch disappointing, but that's okay. I mean, you don't have to really look at quarter on quarter. So two triggers to me is one, more clarity on tariffs. Second, with Sun Pharma in particular, the specialty component picking up, and the contribution coming from some of the new drugs coming, including the cancer drug. My sense is the bigger opportunity is CDMO, Surabhi, and I think if you see the Biosecure Act, which right now has not been tabled up, it actually specifically, names about 5 Chinese companies, and they're very, very concerned on gene mapping and genetic data. And China has more than 20% market share. A lot of their companies like Lonza, etc., they do $5, $6, $7 billion top line. A lot of our companies are not even 1/3, 1/5 of it. And a lot of the companies we have, which is, let's say, DVs, we saw fantastic numbers, Laurus, Newland, Hikal, a lot of them have been around. They have a track record with US FDA and they have good chemistry skills, especially in the late life cycle strategies. So I think CDMO is a huge opportunity. In fact, it is as big an opportunity as IT outsourcing was in 90s.
Okay, got that. Gurmeet, we were just chatting with Ronak Omkar from PPFAS. And when you look at the FlexiCap fund, the second largest holding is Bajaj Holding and Investment, the holding company of Bajaj Auto, Bajaj Finance. And I was just checking that Bajaj Holding has outperformed its listed subsidiaries. So the last 5-year stock price CAGR for Bajaj Holding is 46%, outpacing Bajaj Finance at 37% and a Bajaj Auto at 28%. Have you had a look at any of these holding companies, like a Bajaj Holding? Does it make sense to buy the parent sort of instead of the subsidiaries?
So, Rima, we took exposure in 2 of them. One was TVS Holdings, one was Bajaj Holding. And this was when the SEBI circular came on, getting the right intrinsic value through the derivative position, because holding companies were at 50, 60, 70% discount. Bajaj Holding, we almost entered at 8,000 odd levels, but we booked our profit much earlier than what the price you're seeing now, because for us it was a tactical move. Bajaj Holdings in particular, also, I think, they've done well. One, obviously, it's a holding company. Second, I think the alliance, they are right now also trying to get the alliance share. A lot of the money is getting rerouted and internally getting restructured there. So there was a similar opportunity which came with, there was the news of Tata Sons getting listed, and Tata Chemical, despite its holding, went up briefly, and then the stock is still languishing as such. So I think you can use them as a special situation, more as tactical play. So amongst all of them, we still hold some position in TVS Holdings. Bajaj Holding, we've already exited, almost like 3 months back.
Okay, got that. Gurmeet, stay on. Just a quick word on IT today. Bernstein has come out with a note titled it, turning the corner. They see potential for earnings upgrades and guidance improvement through FY26 for the IT companies. Their top picks are Infosys and Coforge. And the big reason is that if they look at the demand environment, it's strongest for financial sectors. And both these two companies, Infi in the large cap space and Coforge, is highly indexed to BFSI. For Infosys, 30% of the revenue comes in from BFSI, and for Coforge, it's more than 50%. So they expect Infosys to outperform peers, and for Coforge as well, they expect high teens growth to continue. Also, the other data point is that deal activity has been very strong despite all the volatility, geopolitical tensions. The deal wins, the TCV, the total contract value for large cap IT companies went up 20% on a quarter-on-quarter basis in Q4. And also AI adoption, that's the third reason, AI adoption is starting to deliver tangible efficiency gains. So turning the corner, they believe earnings upgrades are in store for IT companies as we parse through the year. Get into a break, we'll come back with more. Welcome back. SEBI says they're not opposed to NSE's listing, says Chairman Tuhin Kanta Pandey. In conversation with CNBC, he commented on NSE's listing and the possible issues that are yet to be resolved.
Is SEBI fundamentally opposed to an NSE listing?
Not at all.
What needs to change within the NSE for SEBI to approve a listing?
I think there are certain issues which are being discussed and flagged, and in my belief is that they're going to be resolved soon.
In your discussions with the NSE, are you getting any clarity then on whether leadership there is making the necessary changes that you have suggested? And just walk us through what needs to change, whether it's on the litigation side. I know that there are issues with the clearinghouse that you have flagged, which we will get on to later. But can you be a bit more specific, sir, on what needs to change at NSE to facilitate a listing ultimately?
I think all of the issues will be resolved. I think that much I can say, both on the governance, litigation, technology, all of it. It's possible to resolve. I think they're quite amenable to solutions.
Above all, is there any progress on the NSE clearing operating independently, which has been among SEBI's requests? And what progress or otherwise is being made on that front?
There has it's not been a definitive direction from SEBI. It was put out as a measure of public consultations in November 2024. Is a possible way whether we could do that, but there are different models in the world, and there is no one model which we can say is the only way we can work. So there are very much possible to resolve things and still move ahead.
Gurmeet is still with us. Gurmeet, any thoughts on NSE? I think you own a lot of NSE. I don't know about BSE, if you've owned it or you still own it. Any thoughts?
Prashant, huge demand in the market, last 3 days in particular. In fact, I think the market is net short, I think, by a few lakh shares. Some of the deals could not go through. So the unlisted price right now, which is going is I mean, obviously there's no definitive prices, but it's gone up from almost 1550 to 1700 plus now. It's almost like a 10% move in 3 days. And I think the reason is that you have BSE, which is trading at whatever it is trading at, gravity-defying valuations, and NSE is still around 30 times. If you take, let's say, 1700 as the price, it's about 4.7, 4.8 lakh crore market cap. And if you put the EPS, that roughly is about 30 times. So there is demand, and NSE is also a lot of now, since the ISN got unfreezed, there's a lot of retail ownership, which has gone up, almost 1 lakh investors now. But I think this entire capital market space, Prashant, looks very, very good. Even asset management companies, you look at the authorized capital for HDFC, AMC or Nippon, and like at 50 crore, you make like 1,500 crores or 2,000 crores a year as profit. I mean, it's almost like infinite ROE. So once you achieve scale, the returns are disproportional. Same for some of the, I think CDSL is also due. I think it made a peak. And so I think a lot of capital market plays, in my view, you should have a significant weightage to the portfolio.
And you're not mentioning wealth management. I'm not joking, Gurmeet. When I was talking to a friend on the sell side broking, he said, "Man, I should join wealth." This is sell side is too much work and not, I guess. But anyway, jokes aside,
you are already managing it to whatever value additions you do. I think we are formally doing it. You are informally doing it.
Yeah, but he's not getting paid for it. That's his problem. Gurmeet, on NSE, the serious question: if somebody has a chunk of money, right, and he wants to kind of sort of deploy it in listed or unlisted or whatever, does NSE make sense? Because there's chatter of listing, etc. I mean, the regulator is much more receptive, so it'll happen at some point. Now, again, people have been saying for a long time, but maybe with change at the top, etc., we are at least hearing about it now once in a while. Is there an unlocking kind of an event once it lists, a significant kind of an upside, a one-time kind of reset?
There could be some now, Prashant. So if you see, I mean, last 2-3 years, the stock is now 6-7x. I remember pre-bonus, it used to be like 2,000, 3,000 bucks. Now, post-bonus, which is 5 times, it's still about 17, 18. So it's been a great wealth creator in an unlisted space. But people have also lost a lot of money in unlisted space in, let's say, a Baiju or Farm Easy. And so there are always winners and losers. So unlisted space is not for retail, in my view. You should not go beyond 5-10% of your portfolio. And IPOs can get to it. IPO is only one of the event, right? NSE, that was anyways liquid. So I don't think so. Unlocking, just unlocking is an event. You should not buy only from a IPO coming perspective. But I think it could be a steady compounder, something that can compound 15-20% earnings for very long periods of time. And we just have like 11 crore investors right now, which are unique. So all capital market play, whether it is NSE or CDSL or CAMS, etc., you can have about 8-10% weightage and then hold it for a longer period of time, because this is a very secular. Look at AMC growth. The AUM has grown now almost 22% CAGR for last 6-7 years. I've been tracking it. Now that's the fastest growing industry. I mean, whichever way you want to look at it.
I don't know. This valuation reset, NSE shareholders are looking at BSE valuations. And
could happen there. Actually, my view, I think, should happen there instead of NSE.
Oh, you're saying that goes down?
Should exchange world over, Prashant, trades at about 20-30 times. You can't have exchange trading at 90-100 multiple on assumption that the market share will keep improving. I think it's too many good things getting priced in. That's my personal view. I've got it wrong. We exited it much earlier as a disclaimer, but I think it looks extremely overvalued, right?
Okay, got it. Now, fair enough. Gurmeet, we leave it there. Thank you very much for joining us. Good conversation as always. Have a good weekend, restful one, and we'll talk to you again. What do we have? 24,850 on the Nifty, 240 points higher. So about 1% in the green. The Nifty Bank is up about 0.83%. The small cap index is up and the mid cap index is also up. So actually, after a spectacular last week, this week has turned out to be pretty decent. If anything, the mid and small cap indices are flat to slightly higher after 7 and 9% gains the previous week. So absolutely nothing to really complain about. Some individual one-off single stock specific accidents, but beyond that, a pretty decent week all told. Rima.
Okay, let's get to the week-to-date action then. On the way up, BEL was the big winner. Good numbers, commentary positive. Stock ends the week with a gain of about 5%, though on Friday it didn't do too much. Stock was flat. HDFC Life, Tata Steel ended the week with gains of about 3.5%. IndusInd Bank, despite reporting a worse than expected loss, much worse than street expectation, it managed to close up on Thursday and Friday and ended the week with gains. On the way down, from a week-to-date point of view, it was Grasim and auto stocks on the back foot, Maruti and M&M, and Sun Pharma too, courtesy the 2% fall on Friday post numbers, but the street was disappointed by the US performance, the generics there. The stock ended down nearly about 2%. All in all, for the week, the Nifty was down close to about 0.6%. Mid-cap index also staring at a knock of about 0.5%. Well, that brings us to a close on Closing Bell. Don't go anywhere, because on the other side is our very special Editors Roundtable.